I would now like to turn to liquidity and financial market conditions. As I have reiterated several times in my previous policy statements, excessive liquidity can pose risks to both price and financial stability. To ensure that liquidity conditions evolve in sync with the monetary policy stance, the Reserve Bank, as a temporary measure, had imposed an incremental cash reserve ratio, that is ICRR, of 10%, which impounded about rupees 1.1 lakh crore from the banking system. The ICRR was reviewed on September 8th and is being discontinued in a phased manner ending October 7th, that is tomorrow. Moderation in excess liquidity conditions as a result of the combined impact of ICRR and advance tax outflows in September has resulted in greater recourse to marginal standing facility, that is MSF, by the banks. Elevated levels of MSF borrowings amidst substantial funds parked under the standing deposit facility is symptomatic of skewed liquidity distribution in the banking system. So what's happening is that a set of banks, they are depositing in the SDF every day more than 1 lakh crores. Sometimes it exceeds 1.5 lakh crores. At the same time, there are other banks which are borrowing from the marginal standing facility of the Reserve Bank of an equivalent amount. So obviously, the distribution of liquidity in the banking system is skewed. This got reflected in the firming up of weighted average call rate, that is WACR, which is the operating target of monetary policy. Despite such hardening at the short end of the term structure, the average term spread in G-Secs, in the government securities market, that is 10-year minus 91-day T-bills, remained at around 40 basis points in August and September, suggesting stable financial conditions. In recent months, banks have preferred to place funds under the overnight SDF instead of offering them in the main 14-day variable rate reverse repo operations, that is VRRR operations. It is imperative that banks assess their actual liquidity requirements over the reserve maintenance cycle and bid accordingly in the auctions under the main 14-day VRR operations of the Reserve Bank. It is desirable that banks having surplus funds explore lending opportunities in the interbank call market rather than passively parking funds in the SDF at relatively less attractive rates. Greater volume of call money transactions would not only help in deepening the interbank money market, but also lower the recourse of deficit banks to the MSF. The release of the remaining impounded ICRR funds tomorrow, along with pickup in government spending, are expected to ease liquidity conditions. Festival time increase in currency demand may of course act as a counterbalancing factor. It's a turning pitch and we will play our shots very carefully. Going forward, while remaining nimble, we may have to consider OMO sales, that is open market sales of government securities, to manage liquidity consistent with the stance of monetary policy. The timing and quantum of such operations will depend on the evolving liquidity conditions. I would now like to touch upon financial stability. The Indian banking system continues to be resilient, backed by improved asset quality, stable credit growth, and robust earnings growth. The credit growth is broad-based and backed by strong fundamentals of the financial institutions. The financial indicators of the non-banking financial companies are also in line with that of the banking system as per the latest data available for June. Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The need of the hour is robust risk management and stronger underwriting standards. The global financial landscape is rapidly changing, and potential stress may emerge from unanticipated corners. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability. I would now like to touch upon the external sector. India's merchandise exports and imports have remained in contractionary zone so far during 23-24, although at a decelerated pace during July and August. Services exports grew at a healthy pace in the first quarter of this year and remained strong during July and August also, driven by software and business services. Inward remittances have risen by 5.8% year-on-year. The current account deficit for the first quarter of the current financial year 23-24 declined to 1.1% of GDP from a year ago. There was an accretion of US $24.4 billion to foreign exchange reserves on balance of payments basis during the first quarter of this current financial year. On external financing, foreign portfolio investment, that is FPI flows, have seen a significant turnaround in 2023-24, with net FPI inflows at US $20.3 billion up to September 23, up to September of this year, as against net outflow in the preceding 2 years. Net foreign direct investment, on the other hand, moderated to $5.8 billion in April to July from $17.3 billion a year ago. The inflows under external commercial borrowings, that is ECBs, witnessed a turnaround with net inflows of $4.5 billion during April-August this year, as against net outflows of $3.2 billion a year ago. The number and total amount of ECB agreements grew markedly during April to August this year, with about 60% of the total amount being raised for capital expenditure. External vulnerability indicators also indicate lower vulnerability in comparison with EME peers. India's foreign exchange reserves stood at $586.9 billion as on September 29 this year. We remain confident of meeting our external financing requirements